Hi everybody, this is Lance from ThetaTraders.com. This video I'm going to go over various hedging ideas. Some of them will involve having a debit, and it's very important to know how much you're willing to spend on insurance, buying a debit, and most likely it's going to expire worthless. We're also going to look at some ideas on how to make it for pretty much a break-even trade, and then in most cases it'll end up being pretty much break even with a very small chance of a really huge gain if we have a black swan event or volatility moves up. Share my screen here. This is a document I left for datatraders.com members. You're going to see most of them already. One of the main things we're going to look at first is if you have a debit and you're okay spending a debit. So first you want to determine how much of your net lick you're willing to lose based on hedging. I'm okay losing up to 0.5% a month if I know that my other option selling trades are making more than that. And then you have that hedge for the big downturns. The three main hedges that I'm going to look at are just buying a simple ES put debit spread. And for a put debit spread, I'd like to go a little bit further out, around 90 days. And then you could do 0.5% of net lick and essentially do these every month. And if you buy a put around 0.07 delta, you can make a pretty large width on that, depending on what your account size is. If you got a little bit higher delta, you have a higher chance at a profit, but it won't necessarily make a ton of profit because your put debit spread will be a smaller width at that point if we're using our certain amount of your net lick every month. One simpler way to go is to simply buy an ES put. You can buy it every 14 days. You have to have that really big move pretty quickly. However, by doing it this short time frame, you can make quite a bit of profit and volatility goes up. And then if you do around 0.25% or so every other Friday, they'll end up being a whole month worth for 2 trades a month. One of the trades I've been using is a 180-day long period out 300 with 111 on ES. So you're going to look to buy the put at the expected move and then make it a 300 with, really large with put debit spread to have a possible big trap profit. And then look to sell that one put at that same cost of the debit. So this isn't a true hedge because you do have two sold puts here against one bought put. However, the sold put is really, really far out of the money. And this is a trade that I did around, I think early June or so, where I have the 300 with 48 to 4,500, and that can make 300 times 50 or 15,000. 300 times 15, make 15,000 on that, but debit spread. The 4,200 will decay a bit quicker than these because they're further out of the money. Here's some other hedges. I'm going to most likely do one like this, especially if we have a pretty big down day. I'm going to look to either sell a 0.3 delta, buy 0.1 delta, or you could just sell a 0.2 delta and then not buy the 0.1 delta. With that credit, or at least with half the credit or so, you could buy one ES put. And then by doing that, you could do it for net credit. Usually I'll spend about half the debit on this and then get the rest in the credit here because sometimes this will stop out on the trade. However, when it doesn't, this will end up closing out near 90% profit or so, and then you'll be able to essentially have this free ES debit as a hedge. And then easier version is just sell a 0.2 delta on MES and buy an ES, which is worth 10 MES. So it's a 1 to 10 ratio. One of the keys to doing these big black swan type hedges is to have a lot more bought puts than sold puts. Because when volatility goes up, you'll be able to make a lot of profit on these. This is an example. Recently, you can essentially sell an MES around 50 days out and around a 0.2 delta. This would take in 52 credit. So if you do 52 times the 5 multiplier on MES, you'd be taking in around $260. We're going to cut that in half and then buy an ES put. It'd be about $130. ES has a 50 multiplier, so divide by 50. And then you would buy an ES put for around 2.5 or so. And this was the trade I did here, 52 days out. You can buy a 3250. That is really, really far out of the money. However, it is like 10 MESs. So you have that really good 1 to 10 ratio of sold to bought puts. And there are some other ones, as you can see here. I'm not going to go through all these now, but if you're a member of theatreers.com, you'll have access to this and any questions you might have. Another one you could do is with VIX. Um, the call ladder is a bit complicated. I think the easier way to go is to just buy zero 0.1 delta VIX calls. That's around 0.25% of your net lick. And you could do that every month or even possibly every 2 weeks or so if you're willing to spend about 0.5% of your net lick. Real quick, if we look at the tasting period here, take a swim. And you can look at around 90 to 120 days or so. For 120 days, we're going to look for a delta of 0.1. You're going to be at around a 32 or so VIX level. And that would be a straight about $120 or so for a debit. So if that's a very small percent of your account, this would take advantage with increasing volatility. As you'll see in the Analyze tab, let me go to Analyze here. And Analyze Trade. And then here you can see with volatility increasing, once you get past that 32 strike, the increases could be exponential up to infinity. Notice the T0 line, that purple line, with a little bit of volatility increase. We're right now around the 21 level. If it increases in volatility only in a few days, this is a few weeks out, you can see that it's already starting to give a decent profit if our volatility goes up to 25 or so. Now this purple line will go towards the green line at expiration. So the longer you have it, the longer you're in the trade, the bigger chance we need that volatility jump in order to get to that profit level. However, we are using this as a true hedge, so it's okay if the VIX level doesn't necessarily go up dramatically because you'll be able to be profiting on other sell side trades. Dark me. All right. So if you have any questions on what I just talked about, send me a comment on the link down below. Or if you're a member of theatreers.com, feel free to ask me any questions there. We're going to be looking at entering one or more of these hedge type trades. And there's also a black swan hedge trade that is a little bit different, put a different spin on it compared to other YouTubers and members out there. That is a pretty useful trade in most cases. It will be for a site debit. And there's really a fine balance between, are you willing to just spend a debit and just do that consistently, knowing that they're usually expire worthless, or are you okay setting them up for close to even no credit or debit? However, one, they're not going to give as much of a hedge, and two, you could theoretically lose money on these as the market drops. So just be aware of all these things. And if you have any questions, again, leave a comment down below. I read and respond to all comments. And I'll see you guys on the next one.